I'm Karina.
I'm Bo.
I'm Monique.
And I'm Megan.
And today we're here to talk to you about Goldman Sachs and its reputation.
Today we will be covering the topics of Goldman Sachs and their successes, the collapse and bailout of AAG, how Abacus AC1 affected Goldman, the Securities and Exchange Commission lawsuit, Goldman's responsibilities to its clients, how Facebook affects Goldman and the SEC, their recovery measures, and how the reputation of Goldman Sachs remains. Goldman Sachs, an American multinational investment banking firm, was originally organized as a partnership but operated as an investment bank. This allowed them to engage in underwriting new securities to raise funds for corporations and public agencies, while advising clients in mergers and acquisitions and managing assets for their clients. Now Goldman Sachs engages in global investment banking, securities trading, risk arbitrage, investment management, and other financial services, primarily with institutional clients. In the 1950s, they developed a philosophy of being long-term greedy, which was interpreted as focusing on long-term profitability rather than short-term performance. After the repeal of the Glass-Steagall Act in 1999, Goldman Sachs decided to go public. After going public, Goldman Sachs estimated that most of their profits would continue to come from investment banking. However, they soon realized that proprietary trading and trading on behalf of their clients began to dominate both its revenue and profit streams. They were named the most prestigious and most profitable of investment banks. And in 2008, Goldman Sachs reorganized as a bank holding company so that they would be under the purview of the Federal Reserve System and could receive capital from it. During the financial crisis, Goldman outperformed all other banks. Their success brought speculation on the company that they might have taken advantage of their clients. A series of events, which we will now describe, raised questions about Goldman Sachs' business conduct and which challenged its reputation. And now, Bo is going to discuss a little bit about the AIG bailout and fail.
Okay, so basically the collapse of AIG can be traced back to three main aspects or three main keys. The first one would be the irresponsibility they had when dealing with credit default swaps or CDSs. The next one would be the fact that those CDSs were unregulated at the time. And lastly, that Goldman Sachs started to demand collateral for those CDSs when they began to see AIG wasn't doing as well as they'd hoped. First, I want to talk about what exactly a credit default swap is. Basically, you can think about it as a car insurance policy where you'd like to get insurance on something, you go to the insurance company, you pay them monthly premiums, and in return, they pay for your losses on that item if the item is damaged or lost. Where these differ, where regular insurance differs from credit default swaps is that CDSs operate in a derivatives universe, which basically means that multiple people can have insurance on the same item. So if an item fails or an item is lost, then the insurance company is forced to pay losses on that item to multiple people instead of just one person. You can see how that could be a problem with AIG if they have credit default swaps on one item for multiple people. The next key reason I mentioned was that they were unregulated at the time. This would be a problem because they weren't forced to keep cash on hand to cover potential losses in the future. And so AIG was able to issue all these credit default swaps and not keep cash on hand in case these investments went bad. In this case, they did. Lastly, AIG failed because Goldman Sachs started to realize that they weren't doing as well as they hoped, and so Goldman started to demand collateral for these CDSs. And as they started to demand more and more collateral for these, AIG wasn't able to meet that demand. And in this case, in 2008, they were forced to ask for a government bailout of $183 billion in TARP funds. Once they received those funds, the subprime mortgage CDOs began to fail, and Goldman Sachs started asking for their money that they were owed because of the CDSs they had. AIG asked Goldman Sachs to absorb some of these losses, and Goldman Sachs stated absolutely not, and we're going to be requiring our full face value for these CDSs. and they received in return $46 billion in TARP funds from AIG. And now we have Emily to talk about the Abacus AC1.
Thanks, Bo. One way that Goldman attracted a lot of outside attention was with the issuance of a series of CDOs under the Abacus name. In the early 2000s, Goldman issued $73 billion of synthetic CDOs, and they also issued mortgage-backed CDOs. Then, in 2007, Paulson and Company came to Goldman and asked them to create the Abacus AC1. Goldman designated Fabrice Touré to design the CDO, and Fabrice contracted ACA management to help participate in the creation of the Abacus AC1. Paulson recommended mortgage-backed securities to be included in Abacus that he believed would fall in value. However, ACA had the final authority to approve the securities. Meanwhile, Fabrice contacted investors and convinced them to invest money in Abacus. Throughout the creation of Abacus, Goldman received $15 million in fees for its services. Then, by shorting Abacus AC1, Paulson reported a profit of $1 billion, while the investors who were convinced by Fabrice to put their money with Abacus lost all their money. By early 2008, the Securities and Exchange Commission asked Paulson and Company for information about Abacus AC1. After a preliminary investigation, the SEC served Goldman with a subpoena in August of 2008, and by July of 2009, Goldman was notified that they could be charged with fraud. Goldman met with the SEC to discuss the allegations, and then on April 16, 2010, the SEC charged Goldman with fraud and also named Fabrice Touré. Goldman's share price fell by 13% that day. Although Goldman called the allegations completely unfounded in law and fact, they recognized that allegations would ruin their reputation, so they began meeting with the SEC in May 2010 seeking a settlement. They reached a settlement where Goldman agreed to forfeit their $15 million in profits made by Abacus and also paid a $535 million fine. However, Goldman admitted no wrongdoing, but instead regretted that the transaction contained incomplete information. After the settlement was announced, Goldman's share prices increased by 5%. Then, in 2010, the UK investigated Goldman and ended up fining the bank £17.5 million for not disclosing that Fabrice Touré, who transferred to London in 2008, was being investigated for fraud in the US. The Abacus CDO attracted a lot of attention from the media for Goldman Sachs, and they're very much in the spotlight and widely reported on for their actions today. Now Monique will talk about Goldman's responsibilities to its clients.
Okay, so Goldman views their clients as sophisticated investors and feel that they're responsible for only providing them with risks. However, Goldman Sachs has a reputation of withholding vital information from its clients. They are accused of foisting bad mortgage-backed securities on unsuspecting clients, as in the case of the Timberwolf CDO. The Timberwolf CDO is composed of portions of other CDOs and other derivatives. Another example of their foul transactions is the housing market crisis. Goldman Sachs made billions betting against the housing market while selling mortgage-related securities to its clients. They were selling toxic mortgage-related securities on Wall Street while executives downplayed the firm's role in financial engineering. In Senate hearings for their Abacus AC1 transaction, Blinken Fine stated that they have to do a better job of striking the balance between what an informed client believes is important to his or her investing goals and what the public believes is overly complex and risky. There will be an ongoing ethical battle of what clients believe they have the right to know and what Goldman Sachs believes they have the right to withhold. Now Karina will tell you about Facebook and the recovery measures.
Thank you. SEC rules impose disclosure requirement of corporation with 500 or more shareholders. This requirement imposed a variety of burdensome reporting requirements and investors' security from regulators and the finance market, and many companies prefer to remain outside the regulatory regime of the SEC as long as they can still raise funds. Facebook was one of those companies, and it needed to raise a large amount of capital to fund its meteoric growth. Goldman Sachs, the company, embarked on an arrangement which Goldman would make a $450 million investment in the company and then raise an additional $1.5 billion in a private placement, while keeping the number of shareholders below 500. The arrangement with Facebook was viewed as a cup for Goldman, since it not only was able to take a stake in the company, but it also was aligned to manage the IPO and other fundraising by Facebook. Facebook has many private investors through previous rounds of fundraising, such as Microsoft, Li Ka-ching, and Alistair Usmanov. Raising the $1.5 billion, Goldman planned to pool the investment of wealthy private investors in a special purpose vehicle or private equity fund as a single investor. The SAC viewed this with skepticism and announced that it was beginning of a reviewing of its rules governing disclosure. Fearing the outcome of the review, Goldman quickly changed its plan for private placement in the United States and announced that it would raise $1 billion from investors outside the United States, concluding that the level of media attention might not be consistent with the proper complication of a U.S. private placement under the U.S. law. And now I'm going to go over recovery measures. So in May 2010, SAC Goldman established a business standard committee to review the business standards and practices. The business standard committee hired a promoting consulting company with interviewing with over 200 clients. And then in January 2011, the business standard committee issued its report with 39 recommendations that Goldman pledged to implement. The report identified the roles Goldman assumed and the responsibility to its client to have to each of its roles. Goldman established a client and business standard committee that put client interest at the center of our decision. To provide greater transparency of its activity, the report recommends recognizing the firm's business segment into 4 classes: investment banking, client service, interest and leading, and investment management. And that would be focused on reputational risk. Firm-wide business standard committee to replace the business standards committee focused on primacy of client interest and reputational risk. Goldman faced heavy criticism for their compensational system for their bank. And in December 2010, Goldman became one of the first Wall Street banks to adopt Say on Pay, giving shareholders a non-binding vote on executing compensation. Under the Dodd-Frank financial reform legislation of SAC was directed to consider promulgating rules requiring firms to provide Say on Pay for their shareholders. On 2 vote, the SAC approved Say on 1 rules in January 2012. And now Megan will conclude.
Okay, despite these challenges, Goldman Sachs has remained one of the best investment banking firms to work for. They offer the highest average compensation out of any other bank. In 2010, 1,300 bankers ranked Goldman as the best place to work for, and in a survey released in January of 2011, they also had Goldman ranked at the top. They remain the most competitive banking firm in the industry, and in their first quarter of 2011, Goldman Sachs lost money in only 1 day of trading and made over $11 million in 32 days. Goldman's reputation remains a respectable one, with the testimonies of some of their biggest clients. For example, Ike Siri of Options Group states that Goldman's reputation is still pristine and well regarded among its clients, competitors, and its employees. They are cutting edge and forefront in the marketplace. Stefan Schwarzman, the CEO of Blackstone Group, expresses his views on the situation. We're a major client of Goldman's and will continue to be a major client. We've never had any circumstance where there's been a question about their ethical behavior. In response to the allegations, Goldman Sachs CEO Lloyd Blankfield states, "Loss of reputation can bring down a firm. It will not bring down Goldman Sachs because we enjoy the confidence and trust of our clients. We don't take it for granted, and we want to work very, very hard to keep what we have and to gain what we may have lost in some cases, and to even expand it beyond that original point." Thank you for viewing our presentation.